So direct lending is what you heard in the previous session. Let's talk a little bit about asset-backed and opportunistic. With me, I have Shafiq Temuri from Stonecrest, and I have Jason from Marathon Asset Management. So let's start with both of you. Can you please introduce your company to the rest of the people, please?
I will, but I promise you none of these slides have anything to do with my company.
I think these are the slides for the last panel.
There. Clickers there. So, hello everyone. Some of you guys I know from the past. We've been working with Faraz's team for a while. I'm Shafiq Temuri, as he mentioned, the Executive VP. I'm actually, last month, celebrated 25 years at the company. So been doing it for a little bit, and our company Stonecrest has been around since 1986, primarily to do real estate acquisition, and that's gone national over the downturn of the last Great Recession, but primarily was in California originally. It also stemmed to a debt piece, and that's the division that I run. We do private lending against primarily California real estate. We've stepped a little bit into Colorado, and that's kind of our overall company profile. We do have a little bit of a foundation that's philanthropic work that we do, CapCon, so I would be remiss not to mention that piece. So we have three focuses: acquisition, lending, and doing good in the community.
Perfect. Jason, can you share with everyone what is Marathon and what are the key elements of Marathon, please?
Sure, and it's a pleasure. And by the way, everyone, I want to both compliment Rizwan and the Accretive team for having an incredible roster of managers for you throughout the day, but more importantly for all of you for actually staying through the day to hear about all of these opportunities. I'm Jason Friedman. I'm one of Marathon's 9 partners. Marathon is a global credit manager with about $22 billion of assets under management. We have offices in New York, London, Tokyo, Luxembourg, Miami, and LA. We are a specialized credit manager, everything from corporate credit to asset-based lending, which we're going to talk a little bit about, to opportunistic and distressed lending, which I think we're also going to talk a little bit about, as well as real estate lending and emerging markets debt.
Okay, perfect. So let's explain what is asset-backed lending. So Shafiq, what is asset-backed lending, and what do you see the benefit of asset-backed lending?
So for us, it's very simple. All of you guys have I've heard of at least own a home, and you have a mortgage, right? And that mortgage is secured against your house. So that is asset-backed. If you default on that loan, it's not just coming to rework out like you heard in the last session where they're getting involved with needing to raise capital for equity or come to do some kind of workout. Their ultimate is ability to go ahead and foreclose on your home and take that collateral back, right? So that's when the last Great Recession, you guys saw a ton of foreclosures happen because loans were upside down and people were walking away and saying, you can have the keys, here's your asset that you secured against. Same thing with commercial, residential, it's the same concept.
All right, now what about you, Jason?
So we're a little different, and obviously I'll talk a little bit about the real estate side of asset-based lending. But basically what I would do is I would step back. So Marathon, we're coming up on our 25th anniversary as a firm. We've been an asset-based lender for about 20 years, but it's diversified asset-based lending. And what do I mean by that? So whereas most of the panels, most of the private equity, all of the direct lending panels you've heard about thus far, were lending against an enterprise value. They were lending against a company and its profitability. What we think about is lending against a perfected security interest in the actual collateral itself. When you heard Shafiq just basically talk about real estate, that's one form of collateral you can lend against. We actually have funds that lend against very diversified types of collateral pools. Literally everything from what we call transportation infrastructure, planes, trains, I don't want to say automobiles because that's a different part, that's consumer, planes, trains, and ships. Obviously real estate, which can be residential or commercial. We have a large healthcare lending team that's both royalty-backed as well as senior secured loans led by a medical doctor and a whole staff of PhDs and basically luminaries in the space, lending against FDA-approved drugs and devices. As well as, from a business perspective, we will lend against corporate assets. That can be everything from property, plant, and equipment to the underlying real estate of a business. So very, very diversified asset-based.
Now let's talk a little bit about why is now a good time to invest in asset-backed lending. Shafiq, why don't we start with you?
So I'm continuing to answer just in the real estate sector because that's really our expertise, right? We're lending against California real estate primarily in both commercial and residential. And right now, for us, it is a rising interest rate market, which is counterintuitive. Most people may think, well, that may hurt us. But in reality, when we're doing short-term lending and private lending that we've done, it was much more challenging when interest rates get compressed, especially with all the money that poured in from Wall Street, chasing yield and coming into our market space. They actually drove down the rates that we could charge on short-term lending, not relative to what we were getting for the same risk level in the past. So currently with rates going up, we can actually not look so expensive. So if I'm giving somebody a short-term bridge loan that's only 6 months long and I'm charging them 10%, if their 30-year mortgage is 6 or 7 versus 3%, they're not going to really balk at it as much as they did in the past. So I had to lower our interest rates down to at least a margin where it was reasonable to what they saw in their bank environment, which compressed our yields. So for us, that's a good thing as long as you know what impact it could have on your asset if it goes up, relatively quickly as it has, and you've underwritten it properly to anticipate those things.
And Jason, you're a diversified investor, so you have various asset classes within your asset-backed lending. Are you seeing broader market opportunities, or are you seeing market opportunities in certain sectors of it?
Sure, no, and maybe to answer the first question that you asked first, and then I'll step into the broader asset classes that we're seeing. If you think about the environment that we are stepping into, and you've heard a lot of macro today about higher rates, inflation higher, maybe as Torsten said, it's coming down, but it's still elevated from that perspective. When you think about that from an underlying perspective, and oh, by the way, the last piece, which none of the other panels have wanted to probably talk about, but I have to say it, you're going to see corporate earnings compression.
Yes.
When you have higher rates, when you have underlying compression, companies will feel that pain.
Yes.
So now think about, where do you want your yield to be coming from? If you're lending against assets, and I'll get into your second question, which is what types of assets, now take all of those factors I just said, a rising rate environment, an inflationary environment, and an environment where corporations may feel pressure on their earnings. On the asset-based side, inflation is your friend. When the assets are worth more, your loan to value is going down on a lending basis. Yes. When rates are rising, most asset-based loans are floating rate. You're earning more on the asset. And when corporations are feeling pressure, they may be looking to assets as a way to generate capital or liquidity. We actually have been saying now for about a year and a half, it is the golden era of credit that we're about to come into, especially on the ABL side. And I promise I won't do too many slides, but when you think about what the difference is between ABL and between corporate, obviously in ABL you're getting both the asset and the cash flows coming off of that asset. So there's, in essence, two forms of protection for that. You're being paid down basically throughout. It's not a bullet maturity at the back end, and it's very uncorrelated to the profits that most of you, if you're business owners or you're working in a corporate enterprise, have to face risk on. We like that. Now, in the asset-based sector, basically now going to Faraz's second question, what assets do we like? We joke about the fact, we love the fact that we're a diversified asset-based lender. Why is that? Because not every asset is always as attractive as other assets at different periods of time. Basically, we've been doing this for about 20 years. We'll get into maybe returns and some of the loss rates and things like that a little bit later. But we've pivoted basically throughout our history in each of our private drawdown vehicles, in our more permanent capital vehicles, to basically move where we think the assets are most attractive. So if you had asked me 3-4 years ago what was attractive, I might have given you a very different answer. And when they were talking about commercial real estate and residential real estate, where as it may be very attractive at certain rates and very unattractive at other environments, we've moved between those asset classes. Where have we pivoted most recently? We've really liked transportation infrastructure and specifically planes, and I'll get into that in a little bit. But then also on the opportunistic side from an asset-based perspective, healthcare, which had been a very difficult place to lend into when biopharmaceutical equities were at all-time highs. When that market crashed and they were down 70% and the venture backers and the valuations were incredibly depressed, suddenly a 14 to 15% loan doesn't look as expensive to those companies. And we found basically pivoting into that in the current environment has been helpful. And once again, each of these asset classes can be attractive in its own right at different periods of time.
Let's go into deeper into the portfolio level, and let's talk a little bit about some cases that you guys have, loans that you guys have made, and let's talk a little bit about your thoughts on what was the need for that real estate loan, and in your case, Jason, what are some of the, if you can share some examples of your portfolio assets.
Yeah, so for us, we really used to lend against the real estate and look at equity and what was called hard money back in, probably before I started at the company. This was really just what people call loan to own. You would give to risky credit and have enough equity if they didn't pay. That environment really shifted, and for us, when we started managing a fund and the downturn happened, we realized that we could really do short-term lending to sophisticated borrowers and still be able to get the yield and get the safety. So our underlying deals is solving problems that you would be surprised. It's 800 credit score borrowers, sometimes millions in the bank or in their stock market, and they're still coming to us for a loan, and you ask why. Why would they come and pay you 10%, 9%, especially when we were in the 2 or 3% environments? Because it's not long-term debt. So I'll give you one simple example. Somebody is going to go, they found their dream home, and they want to buy it, and no one was accepting contingent offers. We all know this in the Bay Area, right? So what do? Do you call your financial advisor and say, hey, liquidate my stock? And he says, well, guess what? You have capital gains on that stock, and then when you buy it back, you have a whole different basis. Now you really want this house, you want your kids in that school district. Well, you come to Stonecrest and you pay them 9% interest rate for 6 months to go ahead and give you that purchase money where they collateralize your equity in your departing home. And then when you sell it, you pay it down and take your permanent financing. So we're only capturing that rate for that short term. So that is just a simple example of many products that we have, but we've created, and I think the differentiation for Stonecrest, at least in that space, is not these individual mom and pop investors that are going and just kicking the tires and hoping they have enough equity. We have a much more sophisticated institutional products that really underwrite to a real strict parameters that really get that churn of money, and we underwrite to the exit. We really want to make sure that the money we take is protected from its downside against the collateral, but solves a problem for the borrower and also has a very reasonable chance of exiting when it's supposed to exit. And so that's just one simple example for us on there. Commercial, someone could get an apartment building and they go to their bank and they go, hey, I just found a great deal. This thing is mismanaged. I'm going to put 40% down, and believe it or not, a lot of the banks will say, no thank you, the asset doesn't cash flow to our debt coverage ratio. Does that make any sense? Well, they come to us, they take a year loan, they pay the higher rate, they go ahead and stabilize the property, get the rent stabilized, and then take their permanent financing. So that's just 2 examples of probably 100 I can give, but I don't want to belabor the point, but it's really these sophisticated real estate investors, either the only consumer product we have is in bridge. We have a line of credit that's available for sophisticated borrowers. They may avoid venture debt or venture equity in their company. They've been successful. They find their real estate. They get our line of credit. Fiduciaries come to us, so I can go on, but there's a lot more sophistication to our borrowers than what people imagine. It's not subprime lending.
And before Jason answers this question in a very similar fashion, I'm sure, I think what you guys would recognize is private markets are solving problems for their clients, either on the private equity side, even on the real estate side, or on the private debt side. Private markets are solution providers to markets, to individuals, which cannot be solved by the public markets. And hence, the private markets have done so well in the last few decades. Jason, on some examples
You stole the thunder, because that is absolutely the case. It's a capital solutions business that we're in. So we are stepping in. I'll give you a couple examples of asset-based loans more recently. We provided a $100 million loan to a biopharmaceutical company.
Remove your lanyard, they're saying.
Is it blocking my microphone?
It must be.
There we go.
Rubbing it.
Or maybe it's causing static. So we provided a $100 million loan where we funded $40 million of it up front for a leading biopharmaceutical company that has basically novel drugs for treatment of certain diseases related to HIV. Lipodystrophy, a couple of the other conditions that may come later in life for those basically people unfortunately afflicted with the disease. In essence, they needed capital for all of their pipeline that they're trying to develop.
Wow.
And the problem is, when the equity market shut, they couldn't raise the capital, so what do? They in essence monetize, for us at a 14-15% rate, the existing revenue stream that they have. We love that type of opportunity where we fund capital up front, and then as they hit milestones and as revenues basically grow in the business, we can fund another $20 million loan and another $20 million loan so that they can see how they're getting that capital to continue their plan going forward. Now, completely separate asset class, in aircraft, what do we like and what has Marathon's history been? We've been a leading provider of mid-life, narrow-body aircraft. So think the Boeing 737s, the Airbus A320s that you fly when you're on your short-distance commuter flights. So for us, that was a fantastic business, basically for now almost 20 years. Then when we led into the pandemic period, we basically made a pivot and we said, okay, let's see what's going to happen to aviation. Now, thankfully, we had no wide-body exposure, which is where the business international traveler got hit. And we also had no, actually last year, Russia, Ukraine, Belarus exposure, because we're basically providing, for example, a plane that we recently had was a 13-year-old Boeing 737 on lease to one of the largest European carriers' subsidiary, where we had a great lease rate on it, basically, and you might say, so how does Marathon get that you're going to get a 14% or 15% return on that? Well, the original owner and lessor of that plane was trying to manage their, basically, life of fleet. They were buying a bunch of new planes and new wide-body planes, and they needed capital. So we can be a capital solutions provider to that counterparty. And maybe last example that I'll give, just because there was actually a more interesting question earlier that I almost wish I had been up here when they asked about foreclosure. And we actually, one of the things that we can do on the residential side, we have a tremendous business of buying legacy whole loan pools off of the money center banks of both the US and overseas. And most people would say, well, what do you mean by that? We're buying basically 15 to 20-year seasoned, sub-performing or non-performing mortgages off of the bank's balance sheets. And most people would say, well, aren't mortgages normally paid off or refinanced or, the velocity's higher? Well, think about it. Yes, that is the majority of the world, but there is a segment that actually have problems throughout the life of the loan. This is not what the bank wants to deal with. They don't have the servicing, they don't have the capabilities. The question that had been asked earlier is, like, what do you do in foreclosure? The reason why we're able to do so much with those portfolios, and we've generated returns in the high 20s often in those portfolios, are we take the sub-performing portfolios, and rather than foreclosing on the loan, which is really not ideal or what you want to do, we buy those loans at 50 to 60 cents on the dollar, then reach out, which the banks haven't done, to the owner of the home and say, here's what we can do. We can forgive 25% of your principal. We can change the amortization payments. We can change the interest rates to get you into a reperforming new mortgage that is highly accretive to us versus our purchase price.
No pun intended, accretive.
No, accretive, there you go, accretive. But great to keep people in their homes. And so we've built these businesses, and people say, like, well, why are the banks, literally every quarter, the money center banks are trying to clean up their balance sheet and get rid of 250 million, 500 million, $1 billion of these loans. And it's a steady stream business that we actually have proprietary nature on.
Now that we've identified some investment opportunities within asset-backed lending, let's talk a little bit about what are the funds available where our clients can consider investing in your funds. So Shafiq, what's the fund available? What's the life? What's the income distribution of the fund?
Our fund is an evergreen fund. So it had a 10-year term. It renews every 5 years. We intend on continuing to renew it. Our first fund in 2004, we stopped accepting funds in 2008 crisis, the crash, because we weren't sure how it was going to fare. It ran its entire 15 years, and now it's gone to 19 with no loss of principal, paid over 7% during the entire both Great Recession that was debt and real estate related, as well as the pandemic and everything else that happened, and it fully liquidated and gave all the funds back. The second fund that started in 2010 because of that, because we had to take capital into a new fund and our investors still believed in us, has grown over that time and has never missed a dividend payment, and Faraz has been in for a decent amount of time, so he can attest to that. We are kind of your steady income component to the portfolio. And that's really where we pride ourselves. We're trying to be diversified in what we really understand. So when we look at it, we're not a $22 billion company that has the resources to look at 5 different asset classes. We come from a local company that's still decent sized, but where's our expertise? We're experts in the lower loan ranges that are typically $5 million and less, and they're mixed between residential and commercial. And every asset we look at, we want to make sure that we can actually understand how to operate it. So that's kind of the overall threshold. It's $300 million. You can come in and our rates, our distribution is monthly, and we expect people to be in about 2 years time frame, because that's about when the loan actually gets a couple of cycles in there and it benefits the other investors. So that's generally $50,000 is the minimum investment that you can come in, and it's 60 days best effort. Beyond that, if you had an emergency less than 2 years, you would contact us. We're flexible. We ask questions at that point.
Wonderful. Jason, what about your ABL fund?
Sure. So we have a couple of different ABL funds. The one that obviously I know Faraz wants me to talk about because it's a limited time offer. And the reason why I say that is we've actually been raising our 3rd secured private strategies fund. It was a $1.25 billion target size.
You can go red.
Oh, red. There we go.
Red is the term. Okay.
No, I think this is the Stonecrest.
No, if you keep on going red.
Back?
Yeah, back, more back. More back.
No, these are our slides, not the fund terms
okay.
slide. It's a separate thing. But from a fund terms perspective, we have Our third secured private strategies, it's coming up on its final close in a little bit over a month at this point. It was a $1.25 billion target size fund. We actually have already raised over $1.3 billion in it, so we will basically come up on our hard cap of $1.6 billion towards the final close. That fund is our third secured private strategies fund. Targets a 10 to 12% net return. Our history has been actually about 14% on average in these prior funds. We actually have a distributing class, so you can get 7% distributed on the fully ramped portfolio on a quarterly basis. And from a business perspective, obviously that's our flagship asset-based lending. The other thing I should mention, and it's something new that basically just happened last year, we were named it's the first single manager perpetual and listed basically asset-based lending fund. Marathon is the name manager on the John Hancock ABL fund, which will ultimately be on iCapital and on a couple of the other platforms from a listed basis. So that is, once again, a newer portfolio.
All right. Now, Jason, let's talk about the opportunistic fund. Okay, what is the opportunistic fund? When is it available? And what are you investing in that opportunistic fund that you're not doing in ABL?
Sure. So ABL is obviously focused on downside protected, collateral oriented, basically, hard collateral security interest. We do know some of Accretive and Faraz's clients were in our last distressed credit fund, MDCF. That is a different type of fund. That's a $2.5 billion fund, and we're actually coming up on the next, which isn't available yet.
Yes.
So you're getting like the preview because it's something that will happen later this year. MDCF 2, and we actually had a fund before MDCF called CEDOF, so we've changed the name in our history. But that is really, when you heard earlier today about opportunistic credit lending, that really has two components. One is basically the private capital solution side. It's a little different than what was described earlier because unlike basically all of the private managers that were up here that we're talking about, the partnerships and the businesses that they run and the sort of ongoing flow, we are really the Houston, we have a problem call from the sponsor universe and the private equity universe. It's when something's really gone wrong and they need a different source of capital that's much more creative and opportunistic, stepping in. Think somewhere between 12 to 15% yield plus equity warrants and upside, where we're actually basically stepping in to help the businesses, either a liquidity problem, a working capital problem, a labor problem. It's what I would call sort of a pre-restructuring. You're trying to help the company and the sponsor or non-sponsor avoid an ultimate restructuring. That's about half the fund. The other half of the fund, which is what tends to get all the headlines and tends to be in the press a lot more, is the basically stressed, distressed investing. That is true bankruptcy reorganization, stepping into debtor in possession facilities, stepping into bankruptcy reorg. Marathon, it's actually part of our founding, was originally on that stressed, distressed. We have bankruptcy lawyers. We have former restructuring advisors. I actually, before I joined Marathon 16 years ago, I spent a decade in private equity where my job was sort of fixing the broken ones at my private equity firm. That business is a very different business, whereas I talked about asset-based lending, 10 to 12% net target on the funds, 1.5 net MOIC. These are like 15 to 20% target IRRs, typically a 1.7 to a 2 times MOIC. And I do have to throw in the commercial right now. We are up for PDI, Private Debt Investor. It's the biggest publication in the industry. This year, we're one of the 4 finalists for both Distressed Firm of the Year and Distressed Deal of the Year.
Nice.
On a global basis.
And
Distressed Deal of the Year is in MDCF, which some of your investors are in. That was basically, I'll give you one quick example.
Sure, please.
That was a company, Europe Car. It was the leading rental car, so think Hertz and Avis in the US. This was their equivalent over in Europe. Obviously, when COVID hit, that company hit a wall, much like the US companies did. It basically required defleeting, restructuring. The capital structure was wrong. The fleet size was wrong. The management, in essence, needed someone to help out. We were one of the 2 largest purchasers at that time of the debt, the secured debt in the capital structure of that business. Helped to lead the company, obviously, alongside the management team with the fastest large cap French mandataire, which is their bankruptcy process. 20 months from start to finish, from basically entering their bankruptcy process to exiting, And 6 months later, we sold the company to Volkswagen for 3 times our money.
So at what stage did you buy this company?
Well, we bought and I think you heard about this earlier from some of the other opportunistic folks and even some of the earlier private equity folks where they say they enter through the debt. We entered through the debt.
Okay, got it.
Pre the restructuring.
Okay, and when will this fund be available for our clients?
Later this year. So it's basically
And
opening.
it's a 5-year fund?
It's a 2.5-year invest.
Yeah.
3-year harvest period.
So
5.5 years.
5.5 years. So it's a 5.5-year fund life, and no income, money will be called in 2.5 years, and the harvesting would be in 3-year period.
Correct.
All right. So Shafiq, on your fund, can you share a little bit about loan to value? Because in real estate, everything is about, hey, what's your protection on the downside? Can you talk a little bit about loan to value in your fund?
Yeah, so this is critical because when you're not getting what I call really exciting returns of 14, 15, 20%, which we had stress funds that we did, it's about protecting the downside. If you are going to get a conservative return, which is heading up with, and it's a lag index because our loans mature and go about at a higher rate, so we are heading towards the 8% return. But you really want to protect the downside. And for us, that's all about what you evaluate the asset and what LTV. So there's 2 components to that. Many people may tout, hey, we have a 50% loan to value. But if you pump up the value of the asset improperly, and you may not have really that true equity protection. So what I mean by that, a simple example, if I could take that time, is that you want to look at, I always use this example of when San Francisco went up really fast. Do you guys remember that when Salesforce and everything was going on, and it jumped up like 20% every year, like for 2-3 years in a row. And that time, we actually pulled our LTVs back. And our sales team was really upset about this because we had our competitors pushing the envelope. San Francisco's on fire. Well, it's not sustained yet. Anything that goes up in 20% chunks, and if you're an equity protection person that's giving out only 7% return, you don't want to risk the capital, like future value construction, land development, or into fluff equity that I call. You really want to look at it and say, hey, this value falls back from where it was 2 years ago, would I still be safe? And if that answer is yes, then you've at least done a really good job of knowing that the protection is there for the downside. So we average in our overall portfolio less than 60%. We've been very close to 50%. But it's a snapshot, right? And the portfolio changes, so I can't say an exact amount, but somewhere in that 50 to 60. So if you had $1 million building, we're somewhere in that 500,000 to 600,000 against it on a conservative way of looking at the value, not necessarily looking at future value, which a lot of Wall Street did. They were looking at fix and flip. They're relying on the borrower's activity to create the value and the market on a spec, right? And then pushing their envelope on their loan to value. So this is the part that kept Stonecrest safe for these times. And that's what I think for us really wanted me to bring to light, that's our secret sauce in terms of keeping the principal side protected even during the 2008, 9, and 10 era.
So one of the key important things to focus on in debt is protection of your capital. You are in a debt position to earn an income, so you can protect your capital.
Correct.
So one way of protecting capital is lower LTV. Jason, on your side, what protection of capital do you guys put in place that there is no loss of capital?
Sure. So, I think Shafiq hit it right on the head. There's return of capital, and then there's return on capital.
Yeah.
So you have to focus on the return of capital in these lending businesses. I know, sort of going back to I had earlier said, 10 to 12% return on our asset-based lending business that we've been doing for 20 plus years. What's our historical annual loss rate? And this is not like the past 3-4 years, which have been a different environment. This is a long-term track record, 12 basis points of average annual loss.
Wow.
That's exactly
what 12 basis points in percentage is 0.12%. So their loss has been 0.12% annualized.
And we actually have what we lovingly call our green bar chart which is basically, I know they had asked the question on one of the earlier panels, like, what's your performance been? Every quarter is green. Every quarter is performing. Through first quarter of the pandemic, through prior cycles and crises, that is basically, once again, getting your loan to value right, where if you're lending at, in our healthcare business is our lowest, that's like 30% LTV. You basically move up to 60 to 65% LTV, basically if we're gonna do something on the CRE or industrial side, that's like the highest LTVs. And it's basically that cushion that you have is what basically protects you when unforeseen circumstances happen. You then have to have the capability to step in and manage the assets, fix the assets, understand the assets. That's our firm's history. I know I talked a lot about it.
No.
I mean, even going back in history, and you mentioned the global financial crisis. Marathon was one of the 8, I don't know how many people remember this, but there was a program called the PPIP, the Public-Private Investment Program. It was the first time in history the US Treasury hired money managers for any reason. And it was basically to fix the mess in the mortgage markets. Marathon was one of those 8 managers. Not only were we one of the 8, we had the highest net multiple of invested capital of any of the 8.
Congratulations. Now, on the fund side, Shafiq, what's your track record been? So you have a 37-year track record. What has your track record been on the fund side?
So our fund, as I said, on both funds has never lost any principal. So if you had your 100,000 that you put in there, the day you take it out, it's been 100,000. And we have never missed a dividend payment on a monthly basis. And our range has been from 7.2, well, I take that back. On our new fund, post-COVID was about 6.7 for last year. So 6.7 to about 9.2% is the range over the whole life of our fund management. That's been about 19 years.
But it'll go up now.
It is on its way up. It does continue to move towards that direction as loans get recycled, because we have 6-month loans to 3-year loans. So as they mature, they go in, and those maturities will go at a higher rate based on markets.
Questions for Shafiq and Jason? Yes, please.
You talked about LTV, right? So I'm assuming that valuation is a big thing in your asset-backed lending. And as you move from industry to industry, you probably would not have the expertise to value a plane versus a ultrasound machine. How do you basically come up with the right valuation, and how do you manage defaults?
It's a great question. And so basically I talked to you a little bit, for example, about our healthcare team, which is led by a medical doctor, has a healthcare advisory board with 6 of the basically leading luminaries in the country. It kind of looks like a venture capital firm, if you look at it, including the current editor of JAMA, the Journal of American Medicine. In each business that we have, you have to have that specialized expertise. It's why we're not a litigation financier. It's why we're not doing music royalties. We have our aviation finance business has a former pilot who had a finance background with a full team of engine valuation, plane metal valuation. Our shipping business, maritime, and I didn't even talk about like our maritime pivot, which is one of the things that everybody in SPS 2, the Secured Private Strategies 2 fund, basically loved in our funds. We made a 4% pivot into medium-sized container ships between April and basically November of 2020. And then the supply chain broke. And suddenly, basically every ship which was in 4th quartile day rates was suddenly in 1st quartile day rates. How do you do that? Well, our team is headed by the former head of transportation and maritime at CIT. You have to have the expertise in that asset, in that metal, in that asset class. Obviously on the housing side, which we've already talked about, I mean, that's our firm's founding. As I said, we were one of the PPIP fund managers, understanding the mortgage market. We literally have billions of data points on homes across the country. So that when we're making a loan and the LTV, we're not just looking at a pool and taking a guess. We're looking at the geo, the zip code, and sometimes the home itself, even though the bank may list it as a securities number, we can actually pinpoint what the house is that's underlying it. And it really comes down to you have to understand the assets that you want to do.
And how do you manage the default?
How do you manage the default? Well, once again, on an underlying basis, you have to be prepared, and as I said, it's a very small instance, you have to be prepared to take the asset back when something goes wrong. Obviously, if you get your underwriting and your collateral valuations right, no one's ever going to give up something that they have 50% equity in. But in those circumstances where it does happen, you have to have the internal, I mean, Marathon has 170 people around the world. You have to have the professionals where you can step in and manage the assets if you need to.
Any other? Yes.
On your loans, say last 5 years, have you had to take over any of the loans?
The question is, in the last 5 years, has Stonecrest been able to take a loan because they defaulted on it?
And then you can go back to the 2007, 2008, what happened during that time?
Sure. So in the last 5 years, we've had 2 homes that also had the same characteristics. They were both business line of credits that talked us into we had good equity protection, and they talked us into a story. And so we have made a fundamental underwriting change whenever we see a common denominator or a common pattern that's happened in our underwrite. We just make those adjustments. So we had 2 situations where we had those on the residential side. And one of them came out with, I think the fund got about $900,000 profit on it by the time we were done with it. And that went into our loan loss reserve. So that's there for a rainy day for down the road. On the flip side, on the commercial, we did get bit on a retail shopping center that is, because of the pandemic, they had a huge developer that actually put in the wrong pipes and somehow got through San Jose City, something that nobody could figure. So now it's in a major litigation. Now we have personal guarantees against that litigation. So we have a way of capturing it, but it's just a headache that we should have not gotten into. And it was just a very good client with a long track record that got an unfortunate circumstance. So he's having to sue, he's cooperating with us. But that retail center, as they got stuck with not getting their fire sprinklers done, they lost their tenants and then COVID hit. So a combination of bad circumstances can happen in these things. So we roll up our sleeves, we're working with him, and we helped join our counsel to make sure his counsel was good against the larger behemoth, and I think we're gonna capture everything. But that's been the last 3 years, the last 5 years. In 2008, our first fund, we hit about 17% of our portfolio at the peak that was non-performing. The beauty of asset back is that we took a retail center in Manteca that would have been vacant. We finished our foreclosure, but we kept the restaurant tenant that was actually the original borrower in there at a lower rate, and we still were able to get a 6 cap on it and ride out the market so that we never took the $200,000 loss. We actually made a $50,000 gain at the end, but it took us 8 years. So it takes up our effort, but we know what to do with the collateral. That's why we don't focus on land as much or future value. We want cash flow things that we can make good decisions for the portfolio, and we're a small enough company. I mean, our portfolio is only $300 million, right? And so even though we transact $250 million a year because our money turns so fast, we're really good about sourcing the deals. And so we do run into some issues at times, but we find ways to resolve them there. So that was, hopefully answers your question. That was the peak. But during that time, it's still, our return went from 9.2 to 7.2, and it never took any principal loss. So we were able to manage it with a 2% extra loan loss reserve to manage it against income. So it's not that the fund never realized losses in it. It just was able to manage it against income and create other profits in other areas.
All right, thank you so much, Shafiq and Jason. Thank you for your time.
Yeah.